Looks like the world of crypto is in trouble yet again. After having to file for bankruptcy, FTX is now asking other crypto exchanges to give them back funds they must have accidentally gotten. So what exactly is going on? And what's going on with the Warriors lawsuit? Stay tuned to find out everything we know about how FTX asked other exchanges to help them and more. First up, FTX requests funds from friends. Just a few short days ago, FTX called up its fellow cryptocurrency exchanges for some support. They said that somehow funds drained from the downtrodden exchange are now being moved to other entities via intermediary wallets. The currently bankrupt firm, which is being led by the new FTX Group CEO, namely John J. Ray III, requested its peers to start taking all measures to protect the funds and return them to the estate supervising FTX's bankruptcy. Strangely enough, FTX didn't explicitly specify that the money was being stolen, but instead stated that it was moved from FTX Global without permission. Nice way to avoid the accusation. The business also didn't say which exact wallet addresses the finances were connected with or which exchanges they were relocated to. So where did they come from? The wrongly taken funds in discussion were obtained from FTX one day after the company declared Chapter 11 bankruptcy in Delaware. As per Zach XBT, a pseudonymous blockchain detective extensively trusted by the DeFi community, the hack was worth a lot, roughly $650 million to be exact. So where did the funds go? Based on the trustworthy Zach XBT's findings, a fraction of the funds captured from FTX had been forwarded to two different wallets, one on Solana and the second on Ethereum. Blockchain explorers say that for the respective networks, a number of the cryptocurrencies were later fused to other blockchain systems, including Binance Smart Chain, Polygon, as well as Avalanche. Also, DBank claims that the Ethereum wallet that's connected to FTX's lost funds had 98% of its estimated $258 million on Ethereum as of last Sunday. It possessed 200,735 Ethereum or ETH tokens and 8,184.9 Pax Gold tokens worth roughly $238 million and $14 million respectively. What's more, it also had a holding of 20 other altcoins worth less than $100. Even as Ethereum had the bulk of the wallet's balance, it also contained $1.7 million on Binance Smart Chain, mainly in the form of stablecoin DAI, and now almost $4 million on Avalanche, just about entirely in Tether, which is another stablecoin. Now, it's important to note that it's quite possible that the money can be retrieved in part through other exchanges. Binance froze about $450,000 in funds stolen from Curve Finance back in August, accounting for about 83% of the $570,000 in lost Ethereum. Also, the good thing is that Binance was able to get back part of the money stolen in what has been later deemed to be a strike by the North Korean hacker cell Lazarus Group. This group previously stole $622 million from Axie Infinity's Ronin network last April. Binance was able to retrieve $5.8 million from 86 different accounts, which is nothing less than a miracle if you ask us. Don't go anywhere. We still have a lot more crypto news to unpack. What is happening with the Golden State Warriors? It seems that the Golden State Warriors are having to face a second lawsuit as a result of the collapse of FTX, previously one of the world's biggest virtual currency exchange firms. What happened was an FTX consumer accused the ruling champions of irresponsibly helping to promote the faulty cryptocurrency firm that declared bankruptcy earlier this month in a proposed class action lawsuit, which has been filed only on Monday in San Francisco federal court. The Bay Area News Group acquired the 25-page lawsuit, which names as defendants firstly the FTX founder and former CEO Sam Bankman-Fried and Caroline Ellison, who helped lead Bankman-Fried's training firm called Alameda Research. But what did the Warriors have to do with this? Take this for example. Elliot Lam is a Canadian citizen who resides in Hong Kong, and he allegedly lost $750,000 during the FTX failure. He claimed that the defendants misrepresented FTX as a safe and secure way to invest in cryptocurrency. According to the suit, if Lam had known about FTX's unlicensed securities, he probably wouldn't have put his money in it. The lawsuit also claimed that the Warriors were aware of FTX's misdoings and that they knew, or at least should have known, that their collaboration with the now-bankrupt company was deceptive and fraudulent. Also, the U.S. Attorney's Office for the Southern District of New York began an investigation into FTX quite a while before its great collapse, which left investors and clients having to face losses in the billions of dollars. In a totally different class action lawsuit that was filed not too long ago, Golden State was named along with many other high-profile funders such as Stephen Curry, Tom Brady, and legendary Shaquille O'Neal. According to this lawsuit, FTX and its old CEO Sam Bankman-Fried had been using celebrities to endorse and bring about unsophisticated investors into a Ponzi scheme and advertised its unregistered securities. As part of their collaboration with FTX, the Warriors initially demonstrated in-arena and virtual ads during TV broadcasts. Then, after the company filed for bankruptcy protection under Chapter 11 On the 11th of November, the current champions suddenly stopped all FTX-related marketing assets last week. The final FTX-partnered promo was a Jordan Poole bobblehead giveaway on November 14th, which was organized months in advance. But what led to the downfall of FTX? Until Sam Bankman-Fried's companies went bankrupt earlier in the month, pretty much everyone in the business thought they were hugely profitable, while the budding entrepreneur fed that supposition, and now seems that this wasn't the case, with major losses that dated back to 2021, if not earlier. The financial distress professionals now handling Bankman-Fried's businesses said in a motion filed recently in Delaware District Court that the enterprise's 2021 tax returns had shown a net operating loss backflow of $3.7 billion. What does that mean? It means his companies, which mainly consisted of trading firm Alameda Research, established in 2017, and cryptocurrency exchange FTX, formed in 2019, have lost $3.7 billion since their creation. That's not good. The massive loss is confusing for two main reasons. One, it appears to contradict the image Bankman-Fried has painted of his business, and number two, it deviates from the cryptocurrency industry's pattern of a highly profitable 2021. Bankman-Fried has made multiple public statements about the financials of his businesses. He said last year that Alameda would make $1 billion in revenues in 2020. According to CNBC, FTX's leaked financial statements from 2021 show that it was fruitful in 2021, with $388 million in net income. Bankman-Fried also mentioned in other interviews previously this year that FTX was making a profit, but his words weren't exactly true. The court document, based on Bankman-Fried's own tax records, implies that it was not the case. The document doesn't really specify what portion of the $3.7 billion in residual losses is attributable to each year. Even so, 2021 was a wonderful year for most crypto companies, with Bitcoin increasing by 60%. Coinbase, a publicly listed cryptocurrency exchange in the United States, made $3.6 billion in gross profit in 2021. Alameda contenders such as London-based Wintermute had a great year for sales and profits, but as of today, Wintermute CEO Evgeny Gavoy claims Alameda embezzled billions of dollars in profits in 2021. If such profits had actually been gained, they would have presumably compensated for the net operating losses that were carried forward from the prior startup years. The collapse of FTX not too long ago surprised the industry. Alameda's cumulative losses seem to have urged someone in Bankman-Fried's operation to wrongfully move client funds from FTX to Alameda, leaving FTX susceptible to a withdrawal run that resulted in the company's sudden bankruptcy. The main hypotheses on why Alameda managed to lose so much money range from bad bets to bad accounting records. These theories may describe why Alameda lost a lot of money in 2022 during the crypto crash, but its setbacks prior to 2021 are still a mystery. Now, here's a tip for future crypto investors. The FTX failure should serve as a reminder that any individual company, whether a crypto exchange or a more conventional business, can go bankrupt in difficult times. Kevin Lum, a CFP and the founding member of Foundry Financial in Los Angeles, works with fairly young investors and claims that about half of his clients own cryptocurrency in some form. Although he doesn't believe clients should decrease their exposure, he does believe they should recognize where digital currency is kept and the risk of retaining assets there. He thinks that the demise of FTX will benefit conventional finance companies like Fidelity that are trying to enter the crypto space, since it comes with a certain level of trust. Also, don't forget to be diverse. Experts have warned that a high portion of a single holding, whether it be in stocks, cryptocurrency, or even other assets, can be very risky. Diversifying is always important. The crypto price collapses this year were a harsh lesson in the significance of diversifying one's investment classes for people who had a very high allotment to cryptocurrencies, whether it was in FTX or not. What do you think about the wreck that is FTX? Let us know in the comments below. That's it for today. If you liked the video, please leave a like, share, and subscribe to our channel for more awesome content just like this.